financial system is? People use the financial system for 6 main purposes: to save money for the future, to borrow money for current use, to raise equity capital, to manage their risks, to exchange assets for immediate and future deliveries, and to trade on information. And a well-functioning financial system actually helps people achieve these objectives. In this video, we will discuss these 6 main uses of the financial system to help you understand the reasons why people trade. So by the end of this video, your ability to identify the various uses of the financial system will help you avoid confusion that often leads to poor financial decisions. I hope this interests you and that you will continue to watch the entire video. Saving. Hopefully, most people want to save some funds for a rainy day. People save for retirement, university, vacations, a down payment on a house, and for other big purchases, such as for a car or maybe even a boat. So when you save for retirement, such as contributing to your RRSPs, which is for Canadians, or your 401k, which is for Americans, you are effectively moving some of your current earnings into the future. And a company like Facebook saves money from their sales revenue, all that ad revenue that they earn at Facebook. So they use the revenue so they can acquire other companies, such as Instagram. A person can accomplish this action of moving money from the present and into the future by buying notes, certificates of deposits, bonds, stocks, mutual funds, or even real estate. And technically, instead of simply saving their money, they're placing their money in an asset or an investment vehicle that can provide a fair return. The financial system helps investors like you and me to invest in these vehicles when they're fairly priced and easy to trade. Borrowing. The financial system facilitates borrowing. Everyone seems to want to need or to spend money now which they don't have. So they seek credit, which means borrowing from their future selves. And while companies can raise funds by selling ownership, meaning shares in their company, companies also borrow to fund growth or to take on new capital projects. And in general, banks and investors provide the funds because they expect to be repaid with interest or because they expect to be compensated with dividends and capital gains. Investors realize capital gains when they sell their shares at a higher price than which they purchased them for. And lay people like you and I, we borrow to pay for homes by applying for a mortgage and for personal loans. And you might have even borrowed from a bank to pay your tuition and living expenses with intentions that you will repay these loans after you graduate and are earning a salary. You most likely have a credit card. And did you know that even governments borrow money to pay salaries and subsidize various activities? Governments borrow by selling bonds, and they repay their debt from future taxes. And this is why taxpayers like to scrutinize government spending. It is our money after all. And it's important to remember that most lenders assess the creditworthiness of borrowers. They might check credit scores for personal loans, such as on Equifax, or for companies, banks will check the corporate credit rating. And there are 3 corporate credit rating agencies, namely Moody's, Standard & Poor, and the Fitch ratings. And this chart will give you an idea of the different rating symbols that Moody's and Standard & Poor's issues. So it really ranges from low risk to highest risk and those that are in default. And it also ranges from a grade, which is from investment grade all the way to junk bonds. So lenders typically charge a higher interest rate for riskier borrowers who may not pay back their loans. And did you know that higher yield junk bond ETFs are available for you to buy? But as you guessed, while the returns are potentially higher, so are the risks. So when it comes to borrowing, many homeowners also must pledge their home as collateral for their mortgage. So that means if the mortgage owner does not make mortgage payments, which also is known as defaulting on their mortgage, the lenders can then sell the collateral, which effectively means to evict the homeowner and foreclose the home, and then the bank will use the proceeds to settle the loan. Lenders often will not loan to borrowers who intend to invest in risky projects, especially if the borrowers cannot pledge other capital. And this is where investors step in to supply capital in exchange for equity in a company. So in turn, however, investors will scrutinize how these projects are executed and managed, and they assess if these projects will produce future cash flows. Some of these investors also use colorful language in their scrutiny of management teams, but that will be for another video. Equity capital. We've already touched on this, and as you know, companies can raise money by selling, which is issuing ownership interests in common stock or such as preferred stock. And equity is still simply a mechanism for moving money from the future to the present. So when shareholders purchase shares, the company obtains money in the present in exchange for equity that will be entitled to distribution in the future. So although technically the company does not have to repay the loan to shareholders, equity represents a potential claim on money in the future. So if you watched our last video on financial intermediaries, and I'll put a link in the description box below, the financial system facilitates raising equity capital. Investment banks, for example, help companies issue equities. Brokers help buyers locate sellers and vice versa and arranges the sale. Exchanges list the stocks and trading prices, and regulatory reporting requirements and accounting standards ensure the financial disclosures. So the financial system helps promote capital formation by producing the financial information needed to determine fair prices for equity. And liquid markets help companies raise capital. So that means when shareholders can trade equities easily, they are more willing to participate in the market. Managing risks. The financial system helps manage risks. Everyone, including citizens, companies, and governments, face financial risks. Interest rates and exchange rates can fluctuate, prices can increase, and so forth. And one way to manage these risks are by trading contracts that serve as hedges for the risk. And I'll explain. So let's illustrate risk management with an example. Suppose a grain farmer and a food processor will both face risks related to the price of grain. Okay? So the farmer fears that prices will be lower than expected when his grain is ready for sale, whereas the food processor that fears that prices will be higher than expected when she has to buy the grain from the farmer in the future. So the grain farmer and the food processor face exactly opposite risks. And one way to eliminate their exposures to these risks is by entering into a binding forward contract. So here, the farmer will sell a specified quantity of grain to the food processor at a future date at a mutually agreed upon price. So by entering into a forward contract that sets the future trade price, they both eliminate their exposure to changing grain prices. And it's a kind of guarantee and a way for each of them to sleep better at night. And in addition to forward contracts, they may also use futures contracts, option contracts, or insurance contracts to transfer risk to other entities who are simply more willing to take on those risks. Exchanging assets for immediate delivery, also known as spot market trading. This financial system helps you trade or exchange one asset for another one that is more useful to you. And for example, if you're traveling to England, you might purchase British pounds and convert your US dollars or Canadian dollars into those British pounds. So consider this. Daimler AG, the car manufacturer for Mercedes-Benz, pays its German workers in euros, but the company receives dollars when it sells in the United States. So to convert the money from dollars to euros, Daimler AG trades in the foreign exchange markets. And an Argentinian investor who's worried about the prospects for the Argentine peso inflation or a devaluation of the Argentine peso might purchase gold on the spot gold market. And these trades are considered spot market trades because the instruments trade for immediate delivery. And the financial system facilitates these exchanges when liquid spot markets exist where people can arrange and settle trades without substantial transaction costs. And finally, we have information-motivated trading. Information-motivated traders trade to profit from information that they believe allows them to predict future prices. They want to buy low and sell high. These information-motivated traders expect to earn a return on their information in addition to the normal return expected for bearing the risk through time. So, an example of information-motivated traders can come from portfolio managers. Portfolio managers have expertise in collecting and analyzing information to identify stocks, contracts, and other assets. They can then use their insight to indicate if those assets are under or overvalued. And theoretically, when they are successful, they obtain a greater return than expected. And this is why people pay portfolio managers to, well, manage their investments. Investors trade to move wealth from the present to the future, whereas information-motivated traders trade to profit from superior information about those future values. So if portfolio managers fail to produce a higher return, their efforts will be futile and people will no longer ask them to manage their investments. And the most profitable, well-informed traders are often those that have the most unique insights into future values. You might think of it as predicting as a result of their expertise, or just plain old guessing, or fortune telling. And I'll leave that up to you to decide. But congratulations, you made it to the end of the video. You learned today that people use the financial system for saving, borrowing, raising equity capital, managing risk, exchanging assets in the spot market, and information-motivated trading. You're welcome to leave a comment on what you liked or did not like about the information in this video. And please remember to like, share, subscribe, and hit the notification bell icon. Thank you so much for watching, and hopefully we'll see you very soon in our next video.